If you spent years building your nest egg like me in index funds like the S&P 500, well, you're not alone. That's typically the classic path. We save, we invest, we wait, and well, we hope it works out when we retire. But here's the problem. You're always second guessing, well, have you saved enough? What if the market drops right before I retire? Am I going to run out of money or get hit with some big surprise tax bill? This is the reality that most people, including myself, that follow the traditional growth investing playbook. But there is another approach, a way to turn your portfolio into a steady stream of income that you can actually count on no matter really what the stock market is doing. Today, I'm sitting here with the godfather of income investing, Mr. Steven Bavaria, author of The Income Factory. And we're going to break down what income investing really is, really, more importantly, the mindset shift that it takes to actually start to track your progress so you can really stop worrying and really start living with confidence. So if you're curious about how to make this switch, let's dive in. So, Mr. Steven, thank you so much for joining me today.
Thank you, Jeff. It's a pleasure to be here.
So
I
let's just,
appreciate
yeah, absolutely. Let's just get right into it regarding income investing. So, literally 3 months ago, as I was telling you before we started recording this, I have never heard of income investing. It was always growth investing. I had 99% of my money that was in the stock market in two Vanguard funds, the S&P 500 and the total stock market index fund. And that was it. I was a do-it-yourselfer guy. And I want to define what income investing is and what makes it different than the traditional growth investing.
Well, first of all, thank you for referring to me, I think, as the godfather of income investing. People have been doing income investing, especially large institutional investors, for decades, even generations before me. What I did do was come up with a kind of clever name, the Income Factory, that allows me to explain it and other people, including many without investment backgrounds, to understand what I mean by it in a way that makes it real easy to grasp. So, the way I often explain income investing as opposed to traditional investing is that if you're buying an index fund of S&P 500 stocks, the S&P 500 itself, the stocks in it, the average yield, the cash dividends that they pay on average are about 1.5% a year, a little less right now because the market's up, but say 1.5% in cash every year. So if you're looking to make year after year the 8, 9, 10% total return that you need to make or would want to make if you're growing your income over a lifetime or over the next 20, 30 years looking forward to retirement, or even if you're 55 or 60 and already kind of early retired, but you plan to live hopefully till 85 or 90 or more, you still have to take that long-term view. And that means besides your 1.5% in dividends, you'd need to make another 7 or 8% or so in capital gains on average year after year to have your stock portfolio achieve that
Mhm.
8, 9, 10% compounded growth. And unfortunately, the market doesn't do that for you every year. So it means you also have to have a certain iron nerve to stick with it during the years when the market's only giving you 2 or 3% growth, or worse, 5% negative growth, loss. And so it's very hard. And I tried to be an index investor, and Nobel Prizes have been won by people showing that index investing steady over the course of a lifetime. If you were Rip Van Winkle and just invested in the S&P 500 and went to sleep for even longer than his 20 years or whatever, you'd do very well. But it's tough when it's not going up or going down to stick with it and not say, hey, maybe I should move to the sidelines or whatever. With an income factory or income investing generally, you're you're trying to make you're finding assets. You're looking for assets, which are usually high yield bonds, senior corporate loans, or it could be real estate. It could be other things, but where you're making your income, your total return in the form of 8, 9, 10% cash yields that you get every year, you can reinvest and compound to create your own growth, even if your assets itself never grow in value. If you're earning that steady 7, 8, 9, 10%, and it's going to vary from year to year as interest rates go up and down through economic uh, cycles and everything, but you're going to be reinvesting and growing your income itself at a rate of maybe you're going to double it and redouble it every 10 years if you're earning 7%, or 7 years if you're earning 10%. I mean, there are formulas for calculating that, but you're going to double and redouble it over and over again over 20 years, 30 years, whatever, and achieve the same total return as if you had been in an index fund that was getting that same return, but they'd be getting it in a much more volatile fashion than you are, where you're creating your own growth. Even though your paper you might have paper losses certain years where your principal is worth less. But
Hmm.
when your principal is worth less and you're reinvesting, actually it's earning usually the same yield. You're getting the same cash yield, whether the value of your principal goes up or down during the course of a year. You're getting that same amount. So when you're getting it and the prices have gone down and you're reinvesting at bargain prices and getting higher yields when your market is down than you're be getting when the market for your capital is up. So it really is kind of counterintuitive in a positive way, that way. And the other thing about it, as you get closer to retirement, or at any point in your life when you're going to want to tap your investments and start taking an income out of it, so you're not
Right.
reinvesting all of it, you're taking some of it out each year. If you're in income investing as opposed to index or growth stock type investing, you don't have to worry about what they call sequencing risk. That's where if you have to take 4 or 5 or 6% out every year
Hmm.
and you're earning 8 or 9% in cash, then you can take it out of your cash income, leave some in to reinvest and compound, regardless of what the principal value is, the market value of your basic principal that's generating this cash, regardless of what its price is, doesn't matter to you because you're not tapping into that capital. But
Hmm.
if you've got a growth stock portfolio that's only earning 1.5%, and the price is going up and down every year, hopefully up, but not every year, then if you need to take 4 or 5% out and you're only getting 1.5% in cash, you have to sell some of your stock. I call it, eating your seed corn. And if you have to sell it at in a year where it's down in price, then you're permanently hitting your value to grow in the future. So that sequencing risk, while you don't worry about it too much while you're compounding and growing over time because you're not selling out. Once you hit retirement and have to take some of it out, then you have a real risk in a down year of hurting your ability to have additional growth and cash in the
Hmm.
future. So that's a kind of a summary intro.
Yeah, I really never paid attention to you talk about the cash that these index funds put out, the dividend yield. And then when I started reading your book, I looked up at both of my Vanguard funds, and I'd really never looked at I logged into Vanguard, and I'd never really looked at the transaction history because I just was automatically reinvesting the dividends. I never paid attention to it.
Mm-hmm.
And I think one of the funds was paying or is paying 1.2%, and one was 1.3%. And that just kind of just solidified what you talked about. Now, and I know, and we talked a little bit before we started recording, that what you're talking about isn't like superior. You didn't want to come across of it being superior to the indexing. You're just giving people an option. So with that being said, and I can definitely see, because I've already taken about 50% of my personal portfolio and started the process of shifting it over. So I have about half growth now and half income. And I can see somebody that's getting older, or they want to transition out, early retirement or retirement. But would this also, your type of investing that you're talking about? What about the younger person that maybe is just starting out, or in their 20s or 30s? Is this an alternative to them starting that young, or is this more of an older person's type of investing?
The traditional view would, and if you went to a professional investment manager, they would clearly tell you, no matter what your age, basically, that, well, you've got to be in stocks to grow,
Hmm.
but you should be in some bonds. And by bonds, they don't mean the kind of bonds I buy. They're talking about really high investment grade bonds that would never default, but they wouldn't pay you much interest either, or government bonds. And so they would have you do a balanced portfolio, and there are all kinds of reasons why they do this. In fact, chapter 2 of my book, which you can read in the book, or I've actually got a Seeking Alpha reprint of it, that you can read, but it's pretty much the whole book in one chapter. Not completely, but it gives you the intellectual foundation for it, and it explains why the whole investment community, once they did away with defined benefit plans, where the corporations used to give all their employees until about 30 or 40 years ago, and went to 401ks, which then become IRAs, where you become your own pension manager and have to invest it yourself instead of having an institution provide.
This one,
Yeah,
chapter
chapter
2,
2.
and I've actually got it.
Oh, good.
I got stuff down here highlighted and everything. So yeah,
Yeah, if you want, I'll give you the link to the Seeking Alpha article for anybody who
okay,
doesn't have the book and wants to read the article, and you can post it later. But
excellent.
the point is, this approach, my income factory approach, works just as well for a 25 or 35-year-old looking to a 40 or 50-year investment horizon as an index approach, because many of those same people, even younger people, still have difficulty sitting through down years, uh, and worrying about moving to the sidelines, doing and I often call that moving, getting off the train and being on the station, on the platform, when the train that pulls up starts out again, and
Hmm.
your stocks start going up and you don't own them anymore. So yeah, math is math. So if you're looking for a 9 or 10% return, and you're prepared to reinvest and compound it the same way you would leave your money in an account if it were a stock account,
Hmm.
you're going to get to the same place with an 8, 9, 10% return in an income factory as you would in an index fund that got you that same return on average over many years, but it would be more volatile. The trouble is that even at age 30 or 40, you might sleep better knowing your money is not, in as much of a volatile situation, and that you're creating your own cash, creating your own growth by reinvesting. Yeah, it works at any age.
Yeah.
uh, as I said, it just works even better once you're retired, because you've gotten rid of that risk of having to sell when the
Hmm.
market's down. That's not a problem when you're 45 or 50 or 30, because you're not selling anyway. You know,
Right.
yeah.
I think for me, being a real estate investor is probably easier for me to grasp this concept a little bit better, because I'm used to buying something like a property and not really so much focused on what is it going to be when I sell it. It's, I buy this property like a mobile home park or an RV park, and I'm living off the income,
Hmm.
the tenants and the income, and you're never really having to worry about selling it. So I think that's the easy thing. But for me, and I'm really curious to get your opinion about this. The biggest challenge of this is basically switching. Okay, so I'll break it down for you to kind of dumb this down, because this is kind of how I was thinking. Most people, they log into their investment account, and the way that they think that they're making money, even though they're not, selling any index funds or anything, they're looking at their account total. Okay. So you log into Vanguard and you go, oh, I have I'm up $100,000 this year than last year. I must have made money. And then they may log in a few months later and go, oh, well, my account's down $20,000. So they're always looking at the account balance to judge. And then, if they're in if they're in funds, they can look at that price going up. So for me, that's been the hardest thing to track, because all the dividends have, so if you're switching to something more income, trying to find a way to separate that out, the income, because like you said, the stock price or the fund price, like if it's a closed end fund or something, it it may stay the same, it may go up or down, but you're still getting that income. Is that correct?
Absolutely.
So
And
what would be your recommendation? Are there tools out there, or there spreadsheets, or there trackers to figure out if because right now I've got over 25 different funds, and most of them are from your recommendations from the group that I'm in, Seeking Alpha, your income factory group. And so to me now, now that I've kind of put some money in there, trying to figure out, well, which of those funds do I need to start putting a little more money in? I mean, I can see they're still paying distributions, that sort of thing. But so if you could kind of help me out with that aspect of it, and I think that would help our listeners too.
sure, just for people who are investing, who are subscribers, members of my Inside the Income Factory community on Seeking Alpha, I do I publish a number of model portfolios, and in fact, I've created a couple of live model portfolios that I've taken parts of my Fidelity account and segregated them into separate accounts, and then I'll buy certain funds. I have one that's essentially just credit funds, and then another one that's just high yielding funds for people who are in IRAs and aren't worried about the tax consequences, and another one that's for people using taxable accounts, where I try to just focus on high yielding equity funds that will pay qualified income for tax
Mm-hmm.
purposes, that sort of thing. And on those, because it's very difficult in theory to sometimes analyze and predict how certain kinds of assets and asset classes and funds are going to do in the future. You have a lot of writers who try to do that, who say, "Oh yeah, I recommend this fund, and this is going to happen." I frankly am more humble than that, and I try to buy what I call through the cycle asset classes, really good funds run by professionals who've been doing it for a long time, with the idea that the income will be pretty dependable and stable, but I make no promises or predictions about what the market's going to do to the price of it over
Mm-hmm.
time, because I'm in it for the long time, for the long term. So in general, so that's people who are subscribers. I analyze this and try to present to them who's doing what the returns are and everything. But if you have an account, say at Fidelity, like I do, and I'm not sure what Vanguard has available, or Schwab or some of the others, but Fidelity on their account, especially if you do what they call DRIP, dividend reinvestment programs for a lot of funds. If you're
Mm-hmm.
going to invest in funds and you like the funds and you plan to reinvest and compound, you might as well DRIP many of them. It's an automatic program where your dividends just get automatically reinvested and compounded. And more important, some of the funds will actually reinvest you at a discount. In other words, they'll if to encourage people to dividend reinvest, they give a discount to their market price on the new funds you buy, the new accounts you buy. So um, what Fidelity will report is they'll report if you're on dividend reinvestment, for example, you can look at your account balance from day to day,
Mm-hmm.
and it will include in it over time. It will accumulate and grow with the dividends that are being reinvested. So if you own XYZ fund and it's there, and you've got the dividends reinvesting, the reinvested dividends will continually feed the amount of shares you own, and so the growth in the value of your fund will include over time all of the dividend, the increase in dividends, which is half of your total return calculation. Since the total return calculation for any investment is the cash you receive in dividends or distributions plus the capital gains or losses. So that amount that on your Fidelity fund for each holding will show over time the accumulation of more dividends plus the increase or decrease in market value. Because in other words, your number of shares, I call it, you're reinvesting, so you're increasing the number of machines in your factory. So your factory, as it grows, your income factory will have more and more machines the more and more you reinvest the output of the factory. But then meanwhile, that's not all, because the value of the individual machines in the factory, the holdings that you have, the securities you have, that goes up every day or down. So you constantly have more of these machines in your factory as you're reinvesting, but their value can go up and down. And both of those will be captured by this in a Fidelity account by the total value from day to day of each holding. And then in addition, besides capturing the total value, which shows you what it's grown to or not over time, you can go to something called the dividend view on the same screen, which will then tell you what the average dividend rate, the yield is on each one of your holdings, and it will calculate an estimate of the annual dividend earnings from that investment. So you can not only look at what it's cumulated to in terms of the value of each holding, it then tells you and adds up for the whole account all the earnings for each one of the holdings. So you'll see a couple of different items that help you understand what your income, what it's grown to, what the value has grown to for each holding, and how much it's contributing in cash each year.
So so from what I'm getting out of this, it's pretty similar when you're looking at like a Fidelity account, whether you're a growth or an income investor, it's going to reflect on the balance, like the overall balance.
Well, it'll reflect on the overall balance,
Mm-hmm.
because if it's a growth type investment, if it's a growth stock,
Mm-hmm.
the distribution portion of that won't be adding too many new machines, because you won't be reinvesting as much,
Because
but
it's like
each machine,
lower.
yeah, but you'll have a greater amount of growth, of market growth,
Mm-hmm.
all of which will be captured in that one total value figure for each holding.
So let me see if I have this correct. Let's just use round numbers. Let's say I have a Vanguard S&P 500 fund, and it's
Mm-hmm.
got $100,000 in it,
Right.
and I have a XYZ income fund, maybe one of the ones that you invest in, recommend, that's got $100,000 in it. Okay,
Exactly.
so whenever I keep looking at my Vanguard account, but the Vanguard fund, which only has like 1.2%
Mm-hmm.
dividend, but you're going to have more growth. So let's say it goes up to $105,000. So
That's right.
the majority of that is going to be the growth, the stock growth
Right.
versus the distribution. Is that
That
correct?
that's right. On your example, if you let's say you have 100 shares of something and they're worth $1,000 each, so you have $100,000. That would
Mm-hmm.
be unusual, but and if it only pays you a dividend of like 1 or 2%, you'll be able to buy maybe whatever that is, 1 or 2 more shares that year.
Mm-hmm.
But at the end of the year, your balance will be up to 110, not because you have extra shares, but because each share is worth enough. It's gone up, say, by 8%. So let's say you get 2% in more shares that, from your dividend, and 8% in that they're all worth more. So you now have $110,000 in your account.
Mm-hmm.
With your other example, you've got 100 shares, and so suppose they're paying 10% each. So you'd get, at the end of the year, you'd have no more shares, Sorry, you'd have a lot more shares because you'd have bought 10%, you'd have spent the 10% to buy more shares, but each share may not have gone up at all. But your account now will still be worth 110,000, all because of the reinvested dividends.
Hmm.
And the first one will be worth 110,000, mostly because of the capital gain and a little bit because of reinvested dividends.
Got it.
So if you're confident you're going to get that 8% growth every single year, then you really don't care. Or that
Right.
in the off years, it'll be made up by the other years, and you're going to get it on average. Again, it's a good investment. If you're not confident of that and just want to get the 10% year after year after year and reinvest it. Now, some year, remember, the 10% may drop to 8% or 9% some years, and it's going to average out to some return over time. But year after year, you're going to get most of your income, or even virtually all of it, in cash and not be dependent on capital gains. That's the essence of the
Hmm.
difference.
Well, wouldn't it make, I mean, I could be totally wrong, but if I've got a income based portfolio or fund, again, I could be wrong, but would I kind of be excited if that fund price goes down? Because if I'm reinvesting dividends, I'm getting more shares, right?
It Yes, and it depends on why it goes down. And this gets into some. I can get kind of nerdy, about explaining some of this stuff. Um, if it's gone down because you've picked a fund, and we all can do that. I mean, not every income fund is as good as every other one. So it
Right.
just like every stock you buy, if you're in a growth portfolio, is not as good as every other one. That's why whatever you do, you need to have a lot of diversification. But if uh, so you might have some funds that actually cut their distribution a bit from 10% down to 9%, especially floating rate loan funds where the rates go up and down every quarter. So some years they're higher, some years they're a bit lower. Um, but what was the other part of your question? I'm sort of lost a little.
I asked for if you have an income portfolio and wouldn't you kind of want the stock price
Oh,
to go
yes,
down
that's right.
to get more shares? Or I guess if it's really starting to plummet, should I be worried that, hey, I
That's
got something that's
that's
paying 10% no matter if the stock price is going down? Are they just returning my capital, or
that's
how to look at it?
Yeah, that's the question. And it's very difficult to answer because the answer is it depends, like
Okay.
so many things. If a if you own, for example, a senior loan fund, say your corporate loans, they're great. It's a great asset. You're earning interest from these loans, and that you might, for a corporate high yield senior loan fund, you might earn 9-10%.
Hmm.
Now, certain times when it becomes volatile, credit markets get kind of scary to people, and the secondary market for loans may drop. So you might have loans trading at 85 cents on the dollar, healthy loans. If you have a portfolio of those loans and you're a fund, your loans, if you hold them, you don't plan to sell them into the market at 85 cents. You plan to hold them to maturity. So if you're holding them till maturity, you're going to collect 100 cents on the dollar on your loan, even if its market price is only 85 or 90 cents. So in that case, your net asset value as a fund might actually drop, because if you go out into the market and value your portfolio, which they have to do, funds have to
Hmm.
value their portfolios in the market. The portfolios might only be valued at 95% or 90% of its par value. So your net asset value as a fund that you report might drop. Investors might say, "Oh, wow, this means this loan market's in trouble, and the price will come down." However, if they're recovering their loan, if these loans are repaying at maturity at 100 cents on the dollar, so they're paying their interest, their dividends to us as investors, they're going back into the market, which is depressed. with 100 cents and reinvesting in perfectly good loans that may be selling at 85 or 90 cents. So
Mm.
here again, the fund, just like you're saying, when our value goes down, sometimes if we're not too worried about it and are reinvesting at lower prices and higher yields, it might actually benefit us. It's the same thing. Those funds, like a senior loan fund, it's out buying a loan for 90 cents on the dollar that it's going to hold 3 or 4 years and collect at 100 cents. So it's making a higher spread on that loan because the loan's paying the same yield. It's paying the same amount of dollars, but they've bought it for 90 cents. So the yield on a 90-cent investment is higher than it would be if it were on a 100% investment. But then they're collecting it later on at par. So they're going to make a capital gain in 3 or 4 years. So this is why certain kinds of investments, credit investments, senior loans, CLOs, which are a more complex type of
Hmm.
security. You're securitizing loans and buying them into a leveraged pool, and they benefit as well. When loans are down in price, their market price and NAV goes down, but they're actually able to make more money than ever because they're reinvesting at these bargain prices at discounts, which turn into capital gains later on. So the answer, it can really help you if you're investing in good funds run by real professionals who've been at it a long time in volatile markets, because volatile markets bring prices of good assets down.
Hmm.
And so investors in those good assets, if they don't lose their nerve, can often do better than ever.
Now, I know the majority of your funds that you recommend in your book and on Seeking Alpha, anywhere from the 9 to 11% range of the distributions. Okay.
Mm-hmm.
What are your thoughts about, and for people that are new to this, they won't know this company, but just kind of know that there are companies out there that have these loans like Yield Max that are just not loans. They have these different funds and investments that are paying 50%, 80%, 120% distribution. So when somebody looks at that and go, okay, well, I can invest in this fund and get 9%, but I can invest over here and get 80%. That's a no-brainer. What would you say to that person? How would you evaluate those?
Uh, yeah, we were having this discussion in the chat room of my Inside the Income Factory, literally just yesterday and this morning.
Okay.
And you're right. Some of these funds, and I'm not an expert on them, but my understanding is many of these funds are a form of a covered call fund where they're a covered call. And I'm not experts on this, but I buy some of the funds run by experts. Eaton Vance and others have a lot of covered call funds. Technically, you're buying some asset, often stocks, but they can do it with other things too, Bitcoin, all sorts of things. Where if you just owned the thing itself and held it, you would get a capital gain if it goes up and a capital loss if it goes down. What they do with covered calls, it's an option where you're basically selling to somebody else the right to get the capital gain if it goes above a certain amount.
Strike price, is that what that is?
Yeah. Hmm?
Is
A
that's
strike,
what's
yeah,
called the strike price?
yeah. It'd be, I guess that would be the strike price, and the strike price can be real close to what it currently is. In which
Mhm.
case, you're selling off virtually all the upside in it, and you'd get a bigger premium, an option
Mhm.
premium. You get paid an option premium for selling an option to somebody. So you can option the right to get to get the increase, above today's price or above
Mhm.
some much higher price. The higher the price, that means you're going to get the benefit of it getting to that price. But then once it gets to that price, I guess they'll, well, no, the less likelihood of it getting to that price, the more likelihood you'll get to keep your premium and not have the option called, the higher the price.
Got
So
it.
anyway, they have all kinds of covered call. Covered means you own the thing that you're selling the call, the option on. So anyway, they've got a whole bunch of these out, and now some of them are paying enormous
Hmm.
current yields.
Right.
And my feeling about, I don't fully understand what they're different doing that's so different from other covered call funds that you can buy that have been around for years. But Eaton Vance and JP Morgan and other firms that have been selling covered call funds, closed end funds, and covered call ETFs for years, they make good returns. Eaton Vance has made over 10% per annum, which is an equity return for the last 10 years on a lot of their covered call funds. So I own them. I think they're a great investment as a way to make an income factory return.
Hmm.
But my feeling is if there were a way to make 40% and 50% and all this on a consistent basis going forward, I would expect Eaton Vance and these other professionals who do this for a living and have done it for careers would figure out how to do it and would maybe know how to do it.
Hmm.
And so I'm not about to, I don't mind. I put a toe in the water once in a while on some of these things to sort of see, gee, is this for real? But for the most part, I don't understand how they're able to pay so much. If they've if they've got some new approach, then good for them, and they'll benefit until the rest of the market figures it out. But I have difficulty thinking that this could be going on for so long without the guys and women, men and women who do it for a living and catching on, and figuring it out. So
Got it.
I'm kind of skeptical, but I'm a curmudgeon when it comes to some of this stuff.
All right. So for somebody like me in their 40s or 50s who wants to start experiencing a little bit of financial freedom, because that's my message on this channel, and I think you knew that before we talked about, maybe they want to get to the point that work is optional. They want to, maybe they're working 5 days a week now, and they want to go to 4 days a week or 3 days a week. Can what you're talking about, can this income approach help? And if so, what would you recommend for somebody that's wanting to gradually shift from, like, kind of like me, a pure growth portfolio to an income portfolio, to start that process of cutting? Because time's the most important thing. So what would you recommend, somebody like me that had 100% or just about 100% growth portfolio, they want to start to slow down, they want to start to get some income, have their own income factory. What, maybe give me the first couple steps to start that transition.
Well, yeah, first of all, I keep your expectations reined in because,
Hmm.
as we said, the income factory is just another way to hopefully earn the same sort of equity return that you're already earning if you've invested traditionally and have stuck with it over the years with equity index funds. You probably have done okay. Now, as you get it closer to retirement, you may want to lock in some of the whatever you've made with if you've been a long-term investor, uh, and if you're concerned that, okay, things could get volatile. I mean, there's a lot going on in our country and our world right now that's highly unpredictable. Let's just put it that way. Um, and so an income factory approach might be a way to lock in the ability to make returns, cash returns
Hmm.
at a time when who knows what the prices of stocks are going to do. They've been, I mean, our stock market's been very resilient given all the uncertainty in recent months. I mean, it did drop, but it seems to have come back as it's getting its a certain amount of confidence that maybe everything that we hear about and talk about may not actually turn into reality, but you don't know for sure. So, um, my feeling is with an income factory, you're more likely to uh, have an investment that's going to survive, where the corporate management is going to muddle through and keep its companies alive and paying their debts, for
Hmm.
example, even if their stock goes to hell.
Hmm.
Even if the stock market really collapses, you've got CEOs of corporations and their top management, they have so much skin in the game that they're going to fight like mad, and I think to kind of muddle through and pay their debts.
Yeah.
So I think I would start with moving more into corporate credit, loans, high yield bonds, the sort of things I have. I have a credit only model portfolio that you've seen. Um,
Do you have
that I,
any recommendations for those, like companies or funds
yeah,
or anything? Or
yeah, there are clearly there are some really solid funds around that are mostly credit. Let me just name a few here.
okay,
You've got Ares Dynamic Credit. Ares is a great credit shop, PE firm. I mean, they've just been around for years, and they're solid.
is that
And
is that ARDC?
ARDC,
Okay,
yeah, and it pays around a 9.5% yield.
okay,
It's had actually for the last 5 years, it's had about a 13% average annual return, total return. Now it may have been down when that started. That was during COVID, so a lot of
yeah.
them were down a bit. But it's been really, it's been a really solid outfit. So ARDC is a good one. BGH, that's Barings Global Short Duration High Yield.
hmm
Barings is the name that Mass Mutual Insurance acquired when the actual Barings went bust some years ago, but it's a great old name, and it's Mass Mutual Insurance that owns it. And Mass Mutual, I used to write about them years ago when I wrote about the private placement market. They're just one of the great credit shops that's been doing uh, lending, corporate lending, and for years and years. Barings Global Short Duration High Yield (BGH). It pays a 9.4% yield, and I see it's had an average annual total return for the last 5 years of over 14%. It's a,
BGH,
hmm? Yeah,
BGH.
BGH. Yeah, there are a couple of. It has a few sibling sort of funds that are MPV and MCI, which are also Mass Mutual funds. They've been the top high yield bond funds for years and years. The problem is they've been so successful that now they're closed end funds, so they're selling at premiums that have gotten a little bit out of control. They're up selling at 20% or so or higher premiums above their net asset value. So this is not the time to buy them. I've been writing about them for years, and I owned them for years, made a lot of money on them, but I wouldn't recommend buying them right now. But I'd watch them. Keep those two in mind to watch if they ever start to come down to par again to NAV. Also, there's FS Credit Opportunities. That's a loan fund. It's been doing really well.
That's FSCO.
FSCO, yeah, 11. They're earning about 11% yields. They've had a terrific last past year. They're kind of a new fund, but they're run by FS. I forget what that stands for, but they they they're a really good outfit.
Well, these funds that you're talking about now, with because I'm helping my dad with he's in his 70s,
Hmm.
and I'm helping him with some different things with his portfolio. So would this group be something more? I'm kind of looking more for something that's more conservative, that
Well,
for income, or what
yeah,
what do you recommend?
conservative. If you're going to earn 9 to 10%, which is an equity risk, you're taking. It's not a sure thing,
Right.
but these are good outfits. And I will say, and a couple others just to mention, and then I'll say what I was about to. Like Prudential Insurance is a terrific old time credit outfit. Besides insurance, they've been investing their money for years and years. And they've got an outfit, PGIM. PGIM is the name of their insurance group.
Hmm.
And PGIM Global High Yield, GHY, that's got a 9.2% yield, 11% average annual return for the last 5 years. And then PIMCO, we've all heard of PIMCO. They're a great group when it comes to credit investing, bond investing. They've got a number of funds. One, their PAXS, I like. PIMCO, Access Income, I own. All of these are ones I own and hold in our model portfolios. PAXS, they've got an 11.8% yield, 12% average annual return for the past 3 years. They've only been around for about 4 years. PIMCO's always starting new funds, but they've got the same people running them that have run their other funds. So they're first class. As far as the risk involved in this credit investing, people get freaked out about high yield bonds, the so-called junk
Junk
bonds. That's what
bonds.
a lot of these are. That's what these own. That's the market we're talking about. But I'll tell you, um, I was involved in rating loans and bonds when I worked for Standard and Poor's. My last of several careers, and I learned a lot about the statistics and default rates and everything. For years and years, we've been tracking default rates for high yield bonds. And we know that normally rates are around the 1% to 2% range. They've been a little lower than that lately. But in a real recession, they would go up to maybe 4 or 5% defaults, we're talking about per year. In a horrible recession like the one we had 17, 18 years ago, the Great Recession, they called it, it got up to about 11% default rates in 1 year.
Mm-hmm.
And it's important to realize that with these funds, like with the loan funds, which are secured, you got all the loans are secured by collateral. When they do default, you usually collect 30 to 40%. You recover 60 to 70%. So your loss is only, say, 40% of what defaults. So if you have a 5% default in a recession and you lose 30%, well, you're going to lose 30% of 5% of your portfolio. That's 1.5%. With unsecured bonds, high yield bonds, you may lose 40%. Sorry, you may recover 40% or 50, but say 40%. So you could lose maybe 60% of your portfolio of what I say, a 5% default.
Mm-hmm.
So 60 times, you're going to lose 3% of your portfolio. If you're earning 9 or 10% in interest, and you then lose 3% or 1.5%, that comes out of your interest payment. It won't even touch your principal. It means your interest for that year is down by 2%, 3%, 4%. So you use that, so you use the interest to buy new stuff, but you've never lost any principal. Your interest is down, and that's in that same recession. Imagine what your losses would be on a stock portfolio in that
Right.
recession. They're going to be a lot more than just 2%, 3%. Even in a great recession like we had, 11% defaults, you lose 50% of that. So you've lost 5 or 6%, and here you go. Again, you're earning 10% of income that year. So that comes out of your income and doesn't even touch your principal. So the kind of risk involved in corporate credit is a very different level of risk, I think, and volatility than in a stock portfolio. And if the market goes down, if it gets nervous and the market goes down, as I described earlier, but you're still, most of these loans and bonds whose prices way down, like the price in the Great Recession of 17, 18 years ago, they were selling, healthy loans were selling at 60 cents on the dollar. So the people who stayed in the market and reinvested made out like bandits a few years later when they had all these capital gains. So
Mm-hmm.
that's the dynamic here. So, I'm as old as your father, and I'm invested in all this stuff. And yeah, it's like I used to say, when you're investing in credit, you're just investing on the companies to stay alive. You're not betting on their you're not betting on their doing great, and
Mm-hmm.
thriving and growing their stock and their earnings. You're just betting on not on their staying alive. It's like going to a horse race and being able to invest in the horses to just make it around the track and finish the race.
That's
They don't
pretty
have to
good.
win. They don't have to place or show. It's a very different kind of bet.
Right. So correct me if I'm wrong. Let's say somebody, and this is kind of leading on with the question that I just asked you regarding the previous one, regarding somebody who wants to cut back a little bit and wants to start going more a little bit growth to
Hmm.
income. Let's say that they're smart enough that they figured out they have $10,000 a month in personal expenses, $120,000 a year, and they go, okay, they start to shift over into some of these income funds, and then they notice that they start getting, uh, let's say, $3,000 a month in distributions, whereas before they may have gotten $400 or $500. I mean, real low. So now they're getting $3,000 a month, and their expenses, personal household expenses, are 10,000 a year. So I know you got to pay some taxes and that sort of thing, but to me that kind of, just to kind of keeping it simple, that would be kind of an easy way to start to transition to, okay, well, I've got these funds paying me where I can pull out, let's say, of the $3,000, I can maybe pull out 1,500, let's say half,
Mm-hmm.
and then pay any taxes and reinvest. But would that be kind of a way that people could start to maybe transition to replacing their personal expenses?
Well, that's right. They could.
Mm-hmm.
I mean, this is all a very personal thing, depending on their needs.
Mm-hmm.
So,
But
and,
many times people come to me and they're like, "Hey, I'm tired of working. Can you help me?" And
mhm,
usually I start with, what are your expenses? And 90% of them don't know, and then they'll come back and they'll figure it
mhm,
out. Okay, well, it's ten
yeah,
thousand a month. I'll say, well, literally, you just have to replace yourself to pay your expenses, and then you can cut back. And there's
yeah.
different ways to do it. So that's kind of my thinking.
Oh, yeah. Well, if they've got money that they're saving, I mean, this
Hmm.
all assumes you got to have money to have choices where to invest it. But if
Right.
somebody's been saving somewhat diligently,
Hmm.
ideally, they've set up some sort of a tax deferred Keo fund or whatever your options are. Depending on what field you're in, but most most people, if they've got money, and if you're an individual proprietor, let's say, not working for a company that has a 401k, often you have, I think, Keo plans and IRAs and other options. The ideal thing is if you have money that's in a deferred situation, I would start there. And if it's in, start to, you can sell without incurring a capital gain. They could sell stocks and start to buy some of the kinds of investments I just mentioned and
Hmm.
that you're talking about as well. And it would still be in your tax deferred, um, it'd be in a tax deferred vehicle, but you'd be creating more cash each time, so that each year or each month you'd have the option whether to take it out, take some of the cash and reinvest it so you continue to grow, or and then take some of it out and use it to live on,
Hmm.
to replace a few hours a week that you could cut down on your practice or whatever you
Right.
were doing. So you'd have the same choices if you were doing it in a taxable account as well. If you were investing in an equity account, um, you would have the option of shifting it into a more of an income factory stocks, income factory funds,
Hmm.
and then you'd be getting more cash each time, and you'd have you could reinvest some of it and take some of it out. I would suggest anybody who has a choice and has both of those,
Hmm.
if somebody has a Keo or deferred type of plan, and they also have some taxable investments. I'm not a tax person, but off the top of my head, I would think it might make more sense to switch to the income factory approach inside the tax deferred, because then you can maximize your interest,
Hmm.
your dividends, or from your funds, and not have to pay taxes on it immediately if you're reinvesting it, to kind of grow uh, the thing.
But they're not able to take any of those distributions out till they reach 59 and a half, though, correct?
Oh, right.
Yeah.
That's right. That's right.
So
But
so let's say
okay,
somebody's like
that's right.
51 years
Do
old.
something.
and they're wanting to, it's got to be in a
Well,
taxable
then you
account.
don't have a choice. Yeah,
Right.
if you've got a Keogh or other tax deferred plan that you started years ago, it was probably
Hmm.
with the idea you weren't going to touch it till you're 59, because to touch it sooner, you pay a real penalty
Yeah.
to try to take it out earlier. So what you're talking about, I think, yeah, would mostly be an option for anyone under 59 to do with taxable investments that they
Right.
now have. But the challenge there is if they stay in equity, then yeah, you run the risk of there not being any capital gains in a particular year. But in years where there are capital gains, or if you've got accumulated capital gains, you don't have to sell and turn it into taxable income until you actually plan to spend it. And so to create an income factory with a taxable account would mean taking equities where you're only making 1.5% in cash, but you're only paying tax on that, and
Hmm.
you're allowing the capital gain to grow
Hmm.
without being taxed until you actually take it out. So there could actually be advantages to deferring, if you will, going to an income factory until you're older, I suppose. If it's in a go to it right away if you're in a non-taxable account, then you can
Hmm.
move to it right away and
Right.
not pay any additional taxes until you take it out. But yeah, in a taxable account, I'm not sure I would want to convert it over to an income fund and start paying taxes on income unless you're going to take that income out. So you might convert a portion of it over
Hmm.
and start earning 9 or 10% on that, and then take the whole 9 or 10% out while letting another portion of it stay in an index fund where it's accumulating capital gains, but you don't have to be taxed on it until.
Now, and if one of your funds is in a taxable account, let's
Yeah,
say ARDC, okay,
sure.
let's say it's in a taxable account, and let's say it's paying 9%,
Right.
but this person is reinvesting the dividends. Are you still having to, even though you're not taking that money out, are you still having to pay any taxes each year?
Yes. That's
Okay.
my point.
Hmm.
Because the money is yours. In other words, they're paying you 9.5% every year. Now, if
Right.
you choose to reinvest it either in ARDC or in a building or anything else, it's already once you have the right to take it, it's taxable.
Okay.
Is why That's why if I were going to convert, if I had $100,000 in in investments now in a taxable account, and I wanted to start taking a portion of the income out, I might just take 50,000 of it and invest it in this kind of stuff we've
Got it.
mentioned, where you'll get taxed on it, but that's okay because you're planning to take it all out.
Right.
And then but leave the other part to continue growing as a as an equity fund where you get your where you won't be taxed on the capital gain until you actually.
You take that out.
Yeah,
Okay. Perfect.
yeah,
Well, this is very helpful. The main goal of this talk, I really wanted people to start thinking differently about how their money is invested and what they're wanting to do with it. I encourage people to get the book, The Income Factory, and you also, I'm in your group on Seeking Alpha at seekingalpha.com, and it's
that's right.
under the Income Factory. Is that correct?
If anybody goes, if anybody were to Google my name, Steven Bavaria, they would find my articles on Seeking Alpha, but also inside the Income Factory. If they were to Google that, inside the Income Factory, that would bring them up to the site on Seeking Alpha where they'd learn about my separate subscription service. That
Yep, and it's fantastic. So
Oh, thanks.
encourage people that if you are, I read the book and I have it over here on my shelf, Who Not How. There's a lot of stuff out there, and you're always going to be like, well, how do I do this? How do I do that? Well, you just find the who's, and I found Steven, and I found two other people that I respect. So there's three people that I respect in this income investing arena to look to them because my time is more important just to go to the expert instead of trying to do it myself. And and it's great that I'm able to read a book and then get the author of that book on a podcast. To me, I'm blessed that I'm have that, and then I can turn around and give that information out to whoever wants to watch it. So again, the book's The Income Factory, Seeking Alpha Inside the Income Factory. And hopefully after I've been doing this for, I know it's only been 3 months, maybe I've been doing it for a little over a year, maybe we can revisit and I can tell you how things are going, and I'll probably have some more questions for you if that's okay.
Thank you. It would be a pleasure, as it has been today. I think we're all blessed to be able to do this.
All right. Well, thank you. And we'll be talking soon.
Great. Take care.